Welcome, everyone. Thank you. Thank you for taking time today and join us for our webinar series on the All About Cross-Border Tax Planning and Strategy, Part 2, Multinational Families. Now, maybe 2 weeks ago, you already joined us for our Part 1 on the corporate tax. So today, we're going for the Part 2, and welcome. Hi, my name is Harry Sloan. I'm your moderator today. I am the tax partner at Crow LLP, with over 23 years of experience in providing tax consultation to individuals and business. And there's some administrative item that was earlier shown on the screen that we would like to remind everyone. So during the presentation, if you have any question or need assistance, please do feel free to message us directly. And during the presentation, we appreciate that if you can mute yourself so we can hear the presenter for the content. And at the end of it, we will address any questions that you would like to discuss. And also, please submit your questions via the Q&A panel on the bottom of the screen. We'll monitor and address the question and discuss at the end of the presentation. Also, for promotional purposes, today's meeting will be recorded. So for myself, I was born and grew up in Hong Kong, and I have seen a lot of our clients also came from foreign countries. So with over 23 years of experience in providing tax consultation services to individuals and business, I've seen people for a lot of time are more proactive in doing their tax planning for their business. Now, however, when it comes to their personal tax, this is not necessarily the case. Not because they don't care. They are entrepreneurs, they are business owners, or the decision makers from the high net worth family with their business and investment in different countries, including the US. However, when they look at the US tax system, I always get the question from them, hey, Harriet, the US tax system is very complicated. I can manage my business, my investment. However, how can we make our investment structure more tax efficient? So today, thank you to the Hong Kong Association of Northern California and the Hong Kong Association of New York co-hosting this special event. And also special thanks to Crow LLP and EY bringing us this special tax seminar focused on multinational families. That's you. We are honored to have Brian Rowbotham from Crow LLP and Rex Lowe from EY and talk about more on the tax planning, how it can best fit your need. So let's come to our first speaker. Our first speaker, Brian Rowbotham, he is a tax partner at the Crow LLP. He heads up the San Francisco Global Private Client Services Group, which provides domestic and international tax advice and compliance services to business and individuals operating in the US and abroad. Now, Brian has over 35 years of experience and currently advising the client doing business including in the popular right now, the blockchain enterprises, esports, software gaming, foreign and domestic investment funds in real estate, and the private equity funds, including the executives and their families with their assets and business interests in the US and abroad. He's also engaged to represent clients in the federal and state audit. Now today, Brian will cover a situation that he encounters. So FYI, Brian first started working with clients from Hong Kong in 1988. So we sure can hear a lot from him. Brian, will you please share some tax planning tips with our audience?
Thanks, Harriet. Happy to be part of this program. I wanted to say thanks very much to Michelle and Yanni. They really put a lot of effort out in putting this program together, and also to the Hong Kong Association. It's a great organization and obviously spans the globe. hello to some good friends and clients in Hong Kong that are actually tuning in. So it's already tomorrow there. So it's a kind of an interesting, I'm not sure which way the communications are going, east or west, but I think we've got all, the globe covered today. I'll talk about situations we see. The title Tax Planning for International and Multinational Families is huge because it really includes all the corporate, all the partnership, individual tax issues that come into play. And plus, it's dealing with the international environment. And just from a cautionary note, the international tax area is unlike the domestic, where there's a lot of logic, continuity. International, there's coordination with the foreign elements too. It's not just the US tax planning. So lots of times the logic people might use for personal tax planning or corporate or partnership for their companies or their investments, you have to sort of step out of the US box and just deal with a whole new area of tax laws, and then also coordinate with people where the investments are, if people are coming from Asia or Europe. The time we have is limited, so I'm going to cover 5 or 6 situations that probably apply to a lot of people that are on this call. And so hopefully they're relevant. And later on, at one slide, I'll talk about Eric Ewan. If anybody knows Eric, you should tell him he's the founder of Zoom, which we're all on. And it's too late, Eric. He was worth $2 billion at the beginning of the year, and now he's, I think, worth $16 billion. He should have talked to somebody on this panel before he took off in value. I'll talk a little bit about pre-arrival strategy on one of the slides. So Yanni, we'll go to slide Statue of Liberty. Next slide. Okay, so we're dealing with residency and what allows or what qualifies a person for U.S. residency. There's a counting mechanism, and it's sort of a before you're married and now you're married. It's a little bit like that in the U.S. There are 2 ways you can become a U.S. resident. There's a formula which averages out to about 4 months a year, which is down in the middle of the slide. There's also getting a green card. And ultimately, when you get a green card, you're basically a resident from the moment you first set foot in the US. One of the things about entering the US and becoming a resident, up here at the top, I say taxation and reporting. So the complex area sometimes is not the actual calculation, but they're under US rules. We have to report all our foreign investments, our financial assets, our bank accounts. And so that gets to be a real burden. So a lot of people don't want US residency. They actually frequently expatriate because they don't want to deal with the regulatory and the compliance and notification to the IRS. Some people have been stuck here because of COVID, but there's a revenue procedure. It doesn't really help that much. It allows you, if you see this formula in the middle, you in the current year, if you had 120 days plus a third of the prior and a sixth of the preceding, they'll give you an extra 60-day window in case you exceed 183 days. That's not much. So the COVID exception isn't going to help much. So anyway, just keep in mind, once you become a resident, worldwide inclusion of income, and even if it stays offshore or doesn't come to the US, and also reporting. So go to the next slide, Annie. Okay, so I understand there are a couple of people listening in. They have EB-5 situation. So EB-5 is a visa classification when somebody wishes to invest, immigrate to the US and invest. They have to invest in certain projects for $500,000. It's to encourage investment into the US. So the US will grant maybe 12,000 of these visas annually. Quite a few come from China's the largest, then India, Hong Kong, North Korea. So same rules apply. The Immigration Services will grant a visa, and upon entering the US, everybody becomes a resident. So what happens frequently, the business owner could be the husband or wife. They frequently have to get back and go back to China or Hong Kong and run the businesses. Their wealth is usually in their country of origin, but they're still now stuck here. The kids are going to school. So these folks have two alternatives in filing. And I have on the top on the right, the initial filing can just be a 1040. That's a regular return and worldwide reporting and disclosures. Maybe if there are assets or investments in Hong Kong, the tax in China or Hong Kong will offset or reduce the US tax. There's a second alternative, and it's an incredible alternative. Most people don't know about it. A person, if they're a green card and they've entered the US, but they have to return to their country of origin, it's China, India, or wherever, they are actually more resident in that country of origin, but they have a US green card. If they're going back to a treaty country, they can actually file as a non-resident in the US. And why this is such a big opportunity is it means that they have a green card, the family's in the US, but if they're actually in their home country, in a treaty country like China for substantial part, and they're running their business or whatever, back and forth coming to the US, filing a non-resident return means they can exclude all foreign income. And so it can save substantial amounts of tax. So people don't know about this very often. They say, a green card, you're stuck. Well, that may not be the case. You can't do this with Hong Kong because still Hong Kong's a separate country. But for example, any resident of China that immigrates to the US on an EB-5 visa or other L1 visas, and they're here quite a while, if they go back to China and are running a business or just there for whatever reasons, and they have enough tests of residency in that country, they can file a non-resident return in the US. And just a quick input, there's immigration implications, so you might have to check with your immigration counsel on this. States, just a warning, the states do not follow the US rules. They don't abide by tax treaties. So you have to basically just get input on when you become a resident of whether it's New York or California, et cetera. State rules do not follow federal. So we'll go to the next slide. So pre-arrival planning is huge. And so what this slide basically points out is the typical structure we see. It's either the first non-resident owning investments in stocks and bonds, foreign and US, or they have their assets held in a foreign holding company. That's the middle diagram, which is foreign holdco. A lot of foreign investors own their investments directly. And I don't know about other countries, but in the US, that's a problem. If you go down to the list of bullet points, the last point, if someone's sitting in Hong Kong or China and they own shares of Microsoft, Google, those are US assets, and they are fully taxable in a US estate tax. So we always worry about estate tax exposure, and there's only a $60,000 exemption. So in most cases, when we have foreign clients investing in the US, we advise them to set up a foreign holdco. It could be anywhere. It could be a Hong Kong company, a BVI company. It doesn't really matter, but it essentially insulates the non-resident from estate tax, because a US asset like stocks, publicly traded or private, real estate, those assets are subject to estate tax. And I've had situations where someone would die overseas and the bank would lock down their account and they would not transfer assets to the family until they had proven that they'd filed a return with the IRS, paid their estate tax, and then the bank will, or the brokerage firm will let go of the assets. So this is a huge mistake to overlook. The big point of this slide, though, is when people are moving from offshore to the US and they have assets held in a foreign holdco, we advise people before you arrive, you can file an election, as is the third column. And the election, it's kind of interesting in the US, we can elect how to classify foreign entities offshore. So in the middle, we've got a foreign holdco holding all the US assets and foreign assets. if we elect to have that treated as a pass-through, a disregard, like an LLC, in the US, before arrival, it treats that election as a liquidation of the foreign holdco, and all the assets step up in basis to their fair value. It has no effect on the actual legal structure. It's just a tax election in the US. When you do that, you enter the US and 100% of your assets are stepped up to fair value. Now, that's huge, because if you're holding stocks or other investments globally outside the US, you enter the US. If you don't make this election, you don't have this, if you don't do this, take advantage of this opportunity, then when you sell an asset in the US, the gain is calculated all the way back to your original cost compared to your selling price. So this election is a really big deal for incoming immigrants. We'll go to the next slide. Yeah, this is a tough slide. It took me a while to try to make sense so I could explain it. But we see this often where on the left, we have typical structure, Hong Kong family and US family, both sides. And there's a Hong Kong company, and there's often real estate. It could be other technology companies or whatever. And at some point, the US shareholders may control this Hong Kong company. Some major tax reform occurred 2 years ago, and the effect of the tax reform on this structure is that all the income in that Hong Kong limited company flows right through to those US shareholders currently, and is taxed at 37% ordinary income. If the US shareholders have more than 10%, and those 10% owners own more than 50%. So this is a disaster. Well, it's not a disaster. It just means that even though the monies are staying in Hong Kong, while this is profitable, these US shareholders have to start paying tax currently. They can pull the monies out and get a distribution of dividends, but again, they're taxed at the top rates. So once again, if we have an opportunity to look at this before everything is set up or the business starts to generate income, we would say to the US shareholders, hey, insert a US corp as a second alternative shows. And under current law, this is the way a US company would be taxed on its underlying profits in the Hong Kong company. Current rate's only 21%, and there's a special 50% deduction. So the corporate tax now is only 10.5%. And the US company gets to offset its share of the Hong Kong tax. So the US company tax is zero. So the tax effect of that US company sitting there is zero. Now, however, the dividends profits can be paid right up through the US company to the US shareholders, and they're only taxed at 20%. So if you compare 37% on the left and they're taxed currently with 20% on the right, and they're only taxed at the top when a dividend is distributed, it's a huge benefit. You can keep the funds in the US company and not pay tax. So this is very complicated. I try to boil it down to two slides. Let's go to the next slide. Okay, conceptually, this is where Eric Buell blew it. He should have, before he came, he tried to come to the US. It was an interesting story. 8 times he had to apply to get his visa to come to the US, and he finally got here. And he was at Cisco one day, and he pitched the whole Zoom idea. He's an employee, and they rejected it. So he left Cisco and then set up Zoom, and now he's a multi-billionaire. Well, he should have either used a foreign trust. He should have set the foreign trust or a U.S. dynasty trust up for his family. We had a situation where somebody was like him. The individual pitched a good part of his stock back to his parents in Asia, Taiwan, in fact. And that stock exploded in value, and now it's totally outside the estate. So if you have individuals that are immigrating from Hong Kong to the U.S., and they're very entrepreneurial, or they have a lot of wealth, they really need to consider assigning out. They can gift things away. On the left bottom, there's some gifting comments there. But ultimately, before individuals like this come into the US, or if they're going to form tech companies, et cetera, they should really consider whether they should set up a foreign trust, and the income in the foreign trust is not taxed in the US unless distributed to US beneficiaries. Or they could set up a U.S. dynasty trust, and generationally, that money is never included in the U.S. estates for U.S. beneficiaries. So the foreign trust is very complicated, and there's some rules about accumulating too much income and then distributing out prior year's income. So the foreign trust structure can work, but it's a little more complicated. But the U.S. dynasty trust, we frequently bring that into play, and it keeps all the assets under control in the family. It's taxed like an individual and forever outside the estate of the U.S. beneficiaries. So I guess the answer is, before your family moves over, consider pitching your assets or wealth into a trust. Let's go to the next slide. So this is my last slide, I think. Yeah, and so we frequently are advising people from Asia on buying real estate, and there's two ways to buy three ways to hold real estate: directly, if you're a foreign owner, which is simple, but there's a single level of tax. But if you look down at the bullet points, there's exposure to the 40% estate tax. And again, only a $60,000 exemption for foreign individuals owning U.S. real estate. So the other alternative is a corporate ownership, where you have the foreign owners, a foreign holdco, and the foreign company owns the U.S. real estate. And this is often employed, and the foreign corp, it protects the non-resident beneficiary or non-resident owners from estate tax. So it's more complicated. You've got double tax, you've got corporate tax, you have individual tax at the top, but it does protect against estate tax exposure. So at times we see investment funds coming over from Asia investing in real estate, but they all go through a foreign corp into real estate. And the third alternative, I couldn't really get it all on this one little simple page. It's called a hybrid structure, where ultimately we're setting up a couple of holding companies, intermediate holding companies between the foreign investors and the U.S. real estate. And these hybrid structures are passed through, so you only have a single level of tax. But because the holding structures are resident operating and they have a foreign domicile, it has the protection that the second corporate ownership structure has. So you get the best of single level of tax pass through and protection from the 40% U.S. estate tax. But it is a little more complicated. It doesn't fit in all circumstances. So I think I'm close to my 15 minutes of fame. So I will turn it back over to Harriet. And thanks to everybody for your time, and I'll be around for Q&A.
Thank you, Brian. Thank you. Yeah, I think it's a very good summary of those structure planning, have a few choices. So I'm sure our audience found them very helpful and informative. Before we jump to Rex for other countries, I do have one question that seems like it's raised from one of your earlier slides, which is slide number 3, talking about for green card holders filing non-resident returns. And there's a question came up about regarding Immigration Council. So are you hinting that there's some issue here we should be aware of, or some concern we should pay attention to?
Yes, there is. It ultimately isn't a problem, but when you apply for a green card, you're basically telling the Immigration Service you intend to make the U.S. your permanent home, and assuming you qualify, you get your green card. And so now you are maybe the business owner, you go back to Hong Kong or China, and now you're filing this non-resident return in the U.S., which means that you're really more present in that other country, not the U.S. And so Immigration Council says, well, it's a worrisome thing when you file a non-resident return, because you're sort of filing a return that's contrary to green card status. And so there's some regulations in the immigration rules. But the long and the short of it is, we have a huge number of people that have their green cards. They're really half time back in their country of origin. The key is, you're not going to have problems with your green card because you file a non-resident return, which is absolutely permitted in the tax law. You will jeopardize your green card because you're not returning to the US, you don't have continuing ties. And if you have that problem and you're filing a non-resident return, those add up and it's not a good picture. But the real jeopardy is not really the tax return filing, it's your lack of returning to the US at least a few, 2, maybe 3 times a year, and having family, or just an ongoing permanence that you can point to. So we always tell people, talk to your immigration counsel, we'll get on the phone, so everybody's agreed on this point. And so really it's just getting good input from immigration counsel is not really a problem.
Good idea, Brian. Thank you. Yeah, so for our audience, so as I said, no one shoes fits all. So with your specific situation, so please be reminded that you should consult and recommend to get input from experienced tax advisor before you in place your next tax structure. So thank you, Brian, again. So after checking out on the US tax filing issue here, so let's follow Rex Lowe, our second speaker, to review some of the tax items in Hong Kong. Rex is a senior tax manager from the EY Hong Kong tax practice and is currently based in EY's New York office. He heads up the Hong Kong tax desk. So Rex has over 10 years of experience in Hong Kong tax and business advisories area. And he also assists various Hong Kong and China-based clients on their outbound investment in the US and Europe with tax advice on their investment structure. So in the next 15 minutes, Rex will take us back now to Hong Kong and review some tax item and impact, and with comparison to other popular countries for immigration and pre-immigration planning, such as Australia, Canada, and UK. So let's welcome Rex.
Thanks, Harriet. Hey, everyone, good evening, and good morning to our audience from Hong Kong. Thanks so much for joining us today. As Harriet just mentioned, I'm the Hong Kong desk in EY New York office. Perhaps some of you are curious about my role and what I do here. I'm not going to spend much time to introduce myself. Briefly speaking, my daily work here is to advise the US company about setting up business in Hong Kong and using Hong Kong structure for tax planning purpose. So in the past, I was participating in many events to talk about how good the Hong Kong tax system is and encourage my client to come to Hong Kong. However, today, I'm not going to talk about coming to Hong Kong. The topic for today is about immigration from Hong Kong to other locations. So when we decide to talk about this issue, I think it's a bit challenging because on one hand, I want to tell you Hong Kong is a good place, but at the same time, I'm going to discuss with you your plan to leave the city. I'm just kidding, but it's always true to say Hong Kong is an attractive place. So on the next slide, if you look at the table on the screen, you will understand why. If you work in Hong Kong, you only have to pay 15% of your income as the salaries tax, which is less than half of the other jurisdictions. Then for companies in Hong Kong, the corporate tax rate is only 16.5%, which is relatively low if you compare to other jurisdictions. And even you decide to exit from Hong Kong, the Hong Kong government will not charge you any tax on capital gain. And one of the key points I want to highlight is the taxation principle. As you can see in the first row, Hong Kong tax is on territorial basis, while most of the other jurisdictions adopt worldwide basis. What does it mean? Briefly speaking, as a Hong Kong resident, you only have to pay tax for the income generated in Hong Kong. For example, if you own a property outside Hong Kong, the rental income you receive is not taxable in Hong Kong because such income will be regarded as non-Hong Kong source income. But in many other jurisdictions, income is taxable on worldwide basis. One example is United States. As Brian just mentioned, if you are a green card holder, even your income is from Hong Kong, you may still be subject to tax in US. Because of such taxation principle, tax planning should be done before immigration to those countries. And that's why I'm here today to share with you. After this session, perhaps you may have some questions about the tax rule in those jurisdictions. Bear with me if some of them are outside my area of expertise, but you are most welcome to send us your questions. Because in my team, there are many tax experts from different countries, and I'm sure I can find the best resources to help you. Okay, let's move on to the next slide. Thank you. Today's topic is about immigration. Before going to enjoy your new life in another countries, of course, you have to make a lot of planning, right? Pre-immigration tax planning is one of the things you should do. I understand UK is one of the most popular locations considered by many Hong Kong people. So my presentation will be focusing on UK. As mentioned before, UK adopts worldwide basis. So non-UK income generated by a UK tax resident may also be taxable in UK. But when we talk about UK tax resident, we need to know the difference between domicile tax resident and non-domicile tax resident. Perhaps some of you may think these terms are quite confusing. You may say, well, as I have already moved to UK, why do I still be regarded as non-domicile? Actually, tax resident and domicile are different concepts. Briefly speaking, tax resident is a short-term concept. It mainly represents the location where you reside during a period, while domicile is more a long-term concept. It refers to the location where you are going to have your permanent home over the course of your life. For example, you can retain a domicile in Hong Kong, even if you live in UK for a number of years. From tax perspective, it's important to identify whether you are a domicile tax resident or a non-domicile tax resident. If you are a domicile tax resident, your income outside UK will also be taxable in UK, even though the money is not remitted to UK. But if you are a non-domicile tax resident, there would be some tax planning opportunity. Because as a non-domicile tax resident, you can elect remittance-based taxation. With such taxation election, non-UK income is not taxable if they are not remitted to UK. But some of you may say, hey, I need to spend money in UK, so I can't just keep all those money in Hong Kong. No worries. As long as the income was generated before you become a UK resident, it will not be taxable, even if the money is remitted to UK. Therefore, we call the pre-immigration income as clean capital. Here, I want to give you a very important message. The clean capital must be segregated from the income arising after you become a UK tax resident. Because if the clean capital is mixed with the post-immigration income, when you remit those money in the future, you may not be able to support the amount was derived before your immigration, and therefore the tax authority may disallow your non-taxable claim. To segregate the clean capital, the most common practice is using a separate bank account to hold the pre-immigration income and make sure your post-immigration income will not be transferred to the same bank account. Okay, on the next page, I'm going to talk about securities trading. We all know many Hong Kong people are very keen on speculating in the stock market or making some financial investment. Actually, the tax system in Hong Kong are quite generous to the investor because in Hong Kong, we do not have any tax on capital gain. So normally your income from the stock market are not subject to tax in Hong Kong. Unfortunately, it's not the case in many other jurisdictions. In many countries, you have to pay capital gain tax on your income from securities trading. As discussed earlier, UK adopt worldwide basis. And once you have become a UK tax resident, your income from securities trading in the Hong Kong stock market will also be subject to capital gain tax in UK. So it's important for us to understand how the capital gain is calculated. In UK, capital gain equals to the difference between sales proceeds and the cost of acquisition. For easy reference, I illustrate the mechanism by this diagram. For example, let's say today you purchase some shares from the Hong Kong stock market at 5 million. And assuming 2 years later, you will move to UK and become a UK tax resident. And at that time, the market value of the shares has been increased to 7 million. And then the stocks continue to perform very strongly after your immigration. So let's say 5 years later, the price is increased to 10 million. And then you decide to sell it. Under this scenario, your capital gain is equal to 5 million, which is equal to the difference between the sales proceed, 10 million, and the purchase price. Now let's look at the second scenario. In this scenario, you also purchase the shares at 5 million today. And I assume 2 years later, you will also become a UK tax resident. And at that time, the market value of the shares is also increased to 7 million. But the difference is, in the second scenario, you will sell the shares and realize the gain before immigration. As discussed before, capital gain is not taxable in Hong Kong. And the income you derive before you become a UK tax resident should not be taxable in UK as well. In other words, the 2 million investment gain realized before immigration would not be subject to tax in any jurisdiction. But some of you may say, I expect the shares will continue to perform very strongly, and I really want to hold the stock. No worries, you can repurchase it immediately after disposal. For example, 5 years later, when you sell the share at 10 million, then only 3 million will be subject to tax in UK because the cost of investment under this scenario is 7 million. So when people tell you before immigration to UK, you should rebase the assets by sales and repurchase, they are actually talking about this method to step up the cost base of any capital gain in the future. Okay, for UK, we can reduce the cost base by sales and repurchase. Then how about other jurisdictions? On the next page, we will show you how capital gain is calculated in Australia and Canada. Unlike UK, the cost base of capital gain in Australia and Canada equals to market value at the point of immigration rather than the cost of purchase. So if you move to Australia and Canada, you don't have to step up the cost. And yeah, so unlike UK, you don't have to step up the cost for any future capital gain tax. But it's important for you to keep the document to support the fair market value at the point of your immigration. So in case the tax authority asks you for some supporting document to support the value of your immigration time, then you can provide it to the tax authority. On the last page, I will briefly talk about some factors you should consider for holding UK properties. To be honest, it's quite hard to say which holding structure is the best because some people may want to hold the properties by using some company or trust, and some of them may prefer holding it by himself. But I would like to highlight some factors that you should consider. The first factor you should consider, of course, is the tax rate. Because in UK, the individual income tax, the maximum rate could be 45%. If the maximum rate is applicable to you, then you may consider using a company to hold the properties, because the tax rate for company which receive the rental income is only 19%. And similarly, in the future, if you sell the properties under the individual tax system, the maximum amount of tax could be 28%. But for company, the tax rate is only 19%. So when you design the holding structure, the key thing you should consider should be the tax rate. But besides that, in UK, the tax system also have a tax called ATED. The full name is Annual Tax on Envelope Jewelry. This tax is only applicable to company. But this tax is not applicable to individual. So when you decide the holding structure, the first thing you should consider is your purpose of holding the company. And secondly, you should consider the tax rate. And besides tax, maybe you should also consider your cost of setting up the company and also the cost of maintaining the company. So that's all the tax planning idea I would like to share with you today. Perhaps you may have some questions on that. So here, let me hand over to Harriet again to see what's your questions. Yeah.
Thank you, Rex. That is very informative too. And we are glad to know that we have choices, isn't it? Not only US, you also mentioned about other countries, and your comparison of the tax item. Sure, I believe that our audience should include that on their pre-immigration checklist so they can consider and think through it before they make a choice. But during your talk, I do have one question about, you mentioned about the capital gain tax is basically is tax-free in Hong Kong, but then it's subject to it in other countries. So we talk about the stock and rebasing it. How about for most of the people that I know from Hong Kong, where I came from too, so people will probably sell their properties before they exit Hong Kong and then migrate to other countries. So from that point, for that capital gain tax on the property, would that be applicable, or would that be other tax like the stamp tax?
Right, that's a very good question, because when the people sell the properties, they would likely derive a gain. And as I said, capital gain is not taxable in Hong Kong. However, you may ask how to determine the nature of the gain. For example, whether the gain should be regarded as capital in nature, which is not taxable in Hong Kong, or it would be regarded as trading in nature. The tax law in Hong Kong does not have a very clear guideline about how to determine the nature of the income. But according to some tax cases and the practice law issued by the Hong Kong Tax Authority, basically, the key factor to be considered by the Hong Kong Tax Authority is the intention of holding those properties. For example, if an individual holds the properties for a very long period and he does not have any other similar transaction of properties, then usually the tax authority would accept that the intention of that person to hold the properties is not for trading purpose, and therefore any gain should be regarded as capital in nature and not subject to tax in Hong Kong. But on the other hand, let's say if an individual or a company hold more than 10 properties in Hong Kong, and he has those transactions every month, and also after he purchased the properties, he only hold the properties for, let's say, a few months. Then the Hong Kong Tax Authority may take the position that this guy hold the properties for trading purpose, and therefore the gain derived by him would not be regarded as capital in nature, and therefore it would be subject to the the profit tax in Hong Kong. Yeah, most people, before the immigration, if they sell the properties, usually the tax authority would not deem the income as taxable in Hong Kong.
I see. Thank you, Rex. Thank you. And I think that it done with the presentation. So let's open up the floors for the question. Just a reminder, please submit your question to the Q&A panel and or message us directly only if you need assistance. So right now, I think I see question coming in, and welcome back, Brian. So come back to Earth.
Well, I've done my official talk, so now I'm going to get ahead of Jeff Bezos and leave the Earth. So
maybe there's a good planning there. So we do receive some questions from the audience. Let me just check it out here. So maybe the first one, let's see. Okay, it may probably more for Rex, but let's check it out. So are there efficient ways to shield the US-based asset for a family that would be returning to the UK where allowances are lower and rates higher? So looking for some tax planning about returning to a UK, probably is a UK resident later, but with a US asset. So is there some planning tips for them how to make it a more tax efficient?
Right, for UK, I think the key thing you have to consider is your residency, because as the non-domiciled UK resident, if you have some income outside UK, then before you remit to UK, it would not be taxable in UK. But in case you are a UK domiciled tax resident, then basically all those income, no matter it's in UK or outside UK, it would still be subject to tax in UK. So I think the first thing you have to think about is your tax residency. And then if you are a the UK non-domicile resident, you will have the chance to lower the tax exposure or mitigate the exposure by the timing of the remittance. But besides that, actually, in UK, besides the planning I discussed just now, there are still many other tax planning opportunities. For here, because maybe it's outside my area, but of course, sometimes later, it's very welcome for me to share more information for those tax planning in UK.
Sounds good. Thank you, Rex. So Brian, do you think we have any experience with client actually going back to the UK, but with US assets?
Well, the UK is totally different from the US. They have very generous exclusions for gifting. So a lot of the UK domiciliaries, they will gift away assets, and that's the main approach. But we in the US use trusts and transfer assets to trusts, and that'll often trigger a deemed sale in the UK. So trusts are more difficult, or they have some surprises if you try transferring assets of great value to a trust. I think one thing is, back to Rex on leave the UK. So if you've left the US and are moving to the UK, you've established a UK domicile, you can leave it for a minimum of 3 years and sever your domicile, and then you give away everything you like that's outside the UK. It sounds easy. We've had some clients that stay a while in the UK, they become domiciled there. You will become domiciled after 15 years. So these individuals, they move around, and clearly that is an opportunity. If there's a 5-year gap and before they go back to the UK, it's based, sever your residence. So you need a lot of local advice, hands-on in the UK for sure.
Yeah, I think both Rex and you agree that, and probably we should look into your domicile decision, where you're going, and then make a better detailed planning on it. So maybe more detail can provide later. So I have a next question here. I am a non-US citizen and also non-US resident. So everything non-US, but I have multiple private banking accounts which mostly for advisory, and one is for discretionary. And I have filed my W-8BEN form, which is a US form for foreign person, with 11 with a FATCA status and passive NFFE, and one account with discretion status of the owner document FFI. So look like there were two status being filed on the W-8BEN form for separate account. So will this raise a red flag with the IRS and possibly instigating that an investigation, even though the investment company is only owned by a non-US citizen and a non-US resident? So maybe Brian, do you think?
Well, so there are disclosures that the U.S. and other countries have imposed on the foreign banking or the global banking system, and basically if some U.S. company or individual sets up a bank account in Hong Kong, they have to determine, or where does this individual reside. Whereas the W-8BEN form is what's filed with U.S. brokers and banks to determine when foreign individuals open accounts, foreign companies open accounts, what kind of withholding taxes should apply on income from U.S. bank accounts and such. Generally, U.S. banks can, a foreign person can open a U.S. bank and all the interest is tax-free. There's an exclusion. Dividends are taxable depending on where you are treaty. There's NFI is a foreign financial, or FFI, a foreign financial institution. These are disclosure rules, but they do sink in with the W-8s. None of this shows up on the tax return. These are separate filings. So it's not likely, maybe under an audit, these questions can come up. But these are forms that are filed with the banking institutions or where the monies are deposited, the investments are deposited. I don't know, maybe Rex, you've seen this a lot in Hong Kong, I think.
Yeah, but for Hong Kong, it's much more easy because in Hong Kong, first of all, if you receive the interest income from the bank, it would not be taxable in Hong Kong. Yeah. And then say if you receive any dividend income from the companies or the distribution from any fund, etc., all those distribution income would not be taxable in Hong Kong. And then about the withholding tax, as you just mentioned, in Hong Kong, basically, the interest expense or any dividend distribution will not be subject to any withholding tax in Hong Kong. So I would say in Hong Kong, yeah, it's quite common. And the tax concern is not really big in Hong Kong because the Hong Kong tax system is quite generous to all those taxes.
Yeah, probably though, if I walk into a Hong Kong bank, they're not going to open an account for me because it's very complicated for a foreign, just as it would be for a foreign person to go walk into a U.S. bank if they're living overseas. In the banking itself, it's tough to get in the front door. Once you're in, you have to deal with these filings.
Yeah, in the past it's quite easy, but I agree. So nowadays, for a non-Hong Kong resident to open a bank account, I believe it's not a very easy procedure. Yeah.
Well, I can share my personal experience. Although I was born and grew up in Hong Kong, as I mentioned, I still holding my Hong Kong resident card. But since I came to US for so many years, and I went back 10 years ago to try to open a Hong Kong bank account, it's a whole 9 miles of hurdle I had to get through, prove my resident, where I live, and end up I have to co-join the account with my mom. So she can prove that she is really my mom with my birth certificate. So I am qualified to get a Hong Kong bank account in Hong Kong. It's not easy.
I believe it's something related to FATCA, right? Because you are a US resident. So
correct.
A lot of documents are required. I understand.
Yeah. So, well, I look at the time right now, it's already 6:30, but I still have a few questions. So I will apologize for the one that we cannot address or discuss today. So we will follow up offline and talk to you offline by email. So I believe that we have your registration information and contact information. So we'll follow up afterward. And thanks again for attending the webinar today. Before ending this webinar, there are a few administrative items I would like to bring up on behalf of the Hong Kong Association of Lofton, California, and Hong Kong Association of New York. These two organizations are not-for-profit organizations which focus and aim to foster the connections between the Hong Kong and the US. So hope you like our webinar today. And if you like to be alert for the next upcoming event, that's very easy to do. So simply go to the website and subscribe to their newsletter. And more important, become a member. So this recorded video today for the webinar will become available in the next couple of days. And for your registration, we will send it by an email and you can check it out later from the website of the Hong Kong Association and can revisit this presentation again today. And also, last but not least, there will be a survey pop up after this presentation. And please, we will appreciate your comment and any suggestion for future topics that you would like us to discuss further. Thanks again for attending the webinar today, and also thanks Brian Rowbotham for your time, and also Rex Lowe for your time, giving us such a helpful and informative presentation to our audience. I'm sure we all appreciate and learn a lot from your information. See you again soon. Thanks and bye-bye.